In the past, you've outlined gold's 2008 supply deficit. I think you put it at about 858 tons, showing that that was a 64% decline. And that's against the backdrop of soaring global demand for the yellow metal. You point out that this deficit is the largest since the 70s, our last gold bull market. Would you care to elaborate on this?
Yeah, well, Pierre Lassonde, who, the ex-president of Newmont Mining, very, very bright gentleman, and he has just pointed out that, and I agree with him that, and my analysis is the same, but he just said it a little bit better than I did. These major mining companies, okay, we're starting to see a problem. Within 7 years, the declining production scenarios within 7 years are catastrophic. So as we go down this road, and this is why this is another factor of why we want to look at the junior mining companies, especially those that already have discoveries that you can buy on the cheap right now, because these companies will probably do very well. The majors are going to have to buy these juniors. They have to have their resource. You're going to see a major impetus, I think, where these major mining companies just start buying juniors out left and right. Anybody that's got a project that's either in production or near production or has a big enough resource. And I'm saying at this point, anything that's 1.5 to 2 million ounces or larger will definitely be on the radar screen of these majors now. It used to be 5 million ounces. They've all come out and realized that, hey, if we were waiting around for a junior to find a 5 million ounce, we'd be sitting here twiddling our thumbs and go out of business. We've got to start getting some of these smaller projects and start putting them into production to maintain our livelihood. And so I think they've lowered the bar to 2 to 3 million ounces. They may even start to look at projects under 2 million ounces. So I just see this as being very critical moving forward as you have screaming higher gold prices in the next couple years in this backdrop of rapidly declining reserves and production on the major side. That's about as bullish a case you can get for gold prices and the mining stocks that are related to gold and silver.
Well, speaking of bullish bullion and metals prices, as a bullion dealer at Amerigold, you've talked about a startling trend change in recent months. The amount of bullion available to dealers, it has been sharply curtailed, and that's making it difficult for a lot of dealers to fill customers' orders. You talk about in your article that recently up to 99% of your orders were on the buy side. Are you still seeing numbers near that level?
I mean, literally in the last 3 months, we've had 2 sellers. 2 clients sell. Now, that's highly abnormal. We've been doing this for, over 10 and a half years, and there's never been a time where we've had so few sellers, particularly in a market with so much activity. Everybody wants to buy. Hardly anybody wants to sell. This has put us into a real, strange circumstance. Like I said, a third of the material that we sell to new buyers usually comes from existing clients. 2/3 comes from the new fabricators. But right now, 100% is coming, or 99% is coming from the new fabricators.
You mentioned Jim Sinclair. He's calling, as I'm sure you know, for $1,650 gold, and that's before 2011. However, I interviewed Doug Casey in Montevideo, Uruguay on the phone a few weeks ago. He agrees with you that $1,650 may be way too conservative a target. Doug is now calling for the yellow metal to climb above $3,000, and his forecast seems to coincide with your $3,000 to $5,000 target. Would you care to outline a scenario where you believe this lofty target will be met?
Yeah, I'm projecting for this year. I think gold can hit $2,000 this year. Now,
wow.
I love Jim Sinclair. He's a great individual, and what he does, his service that he provides at his website, jsmindset.com.
And free of charge to folks.
I mean, phenomenal gentleman to do what he's doing.
Takes hundreds of phone calls when the markets are bad.
He's a tremendous gentleman, and I just find him to be very accurate on most things. I think Jim is always very conservative. Now, if you talk to Jim, he would give you a much more bullish stand on what he says in public, the website. So, I mean, his 1650 call, in my opinion, is very, very conservative for what Jim really believes. I'm saying for this year, I see 2009, like I said, as the setup year. I see gold really pushing, maybe hitting that $2,000 level an ounce before the end of the year. But this is where gold starts to become headline news. Once you see that, then the mania phase is going to kick in at some point soon thereafter. And that will take us easily to $3,000 to $5,000. That's conservative. It could be higher than that based on, all the fiat money that exists out there, but you try to get a number. I base my number off of our, what was the last new high in gold. If you inflation adjust the 1980 high gold of $870 an ounce, or $855, intraday trading it was $875. At the end of the day, $855, let's use that number. And you go back to 1980 and inflation adjust it for 28 years with the real rate of inflation. And the way I use my calculation, the way the government calculated inflation, the CPI index back in the 70s, that was an accurate number. After the 70s, they start doctoring with it, playing with it, so it's not an accurate number anymore. But I'm using the correct way of interpreting what real inflation is. So $855, 28 years of true inflation, calculating as the government would have calculated back in the 70s, to equal today's price, in today's terms, gold would have to be $6,500 an ounce. So obviously I believe that what made gold go to $855 in the 70s, late 70s, early 80s, pales in comparison to what we're dealing with now. So an estimate of, gold going back to its old $855 high is conservative in my opinion. So that's the $6,500 mark, and I say, anywhere between $3,000 and $6,000 an ounce is probably very realistic for gold. I believe things are much worse than what they were back in the 70s, and that's where you get into the projection that, hey, it could be much higher than that. How much higher? Who knows? Nobody's got a crystal ball. But then you start doing the calculation based on, well, how much fiat money exists out there trying to chase a very finite asset that's limited in quantity, and you start to get an idea, some of these people that talk about, gold being priced in the tens of thousands of dollars an ounce. Well, that's what they're basing it on. They're basing it on, okay, only X amount of gold exists, all this fiat money, trying to chase after it and get a portion of that cube. It could cause gold to go literally into the stratosphere.